The last session of the day. We will be looking at getting the market view over what we've heard over the course of today's last day of the conference. Just can you believe that we are already into the third day, the final day, where we have had quite an exceptional list of speakers that have brought to the table some very, very dynamic discussions so far. My name is Justine Leigh-Bell. I'm the Deputy CEO at Climate Bonds Initiative. And before I dive in, I'd like to go ahead and get through a few housekeeping before we move on to our session today. First and foremost, I must say that to our sponsors, thank you so much for the support that you have given us to be able to pull off this fantastic conference. It is greatly appreciated, and most importantly, our ability to have you as part of our Climate Bonds family. We greatly appreciate your support, and also to those that supported the translation. We do have translation for the session in 5 different languages. That would be Spanish, Portuguese, Russian, Japanese, and this is something that's available to you as well. We've also got Q&A available on the WOVA app, and so please do use that. And then finally, videos will be available from now until December. So if there's any sessions that you missed, then please do check us out, and to those that you missed. So just to give a briefing to what we've been hearing over the last few days, and to the panelists that we have who will be reacting to those discussions is first, we have Dr. Daniel Klie from HSBC, Chief of Staff of Global Banking and Markets, and also Global Head of Sustainable Finance at HSBC. We also have Sevinc Acar, Investment Director, Fixed Income at PGGM. Thank you for joining us. We also have Anna Anderson, Vice President and ESG Analyst at Moody's Corporation. We have Michael Gaynor from BBVA Credit Research as a Senior Analyst. So thank you very much for joining us. So I think what I would like to do is, before we get into the discussion, I think it would be helpful to our listeners and also to our panelists for what we have actually heard over the course of these 3 days. In session on day 1 for the session highlights, we started off with how to win the transition. And this was very much about the fact that we have a climate crisis ahead of us. We've got governments that need to act, and we have a high carbon industries that need to shift. The urgency and ambition is needed, and investing in fossil fuel sectors is no longer an option. It needs to stop. Green recovery will be critical to get out of the climate crisis. Transition investments will be core to this. What will drive the transition is essentially cheaper renewables, cutting edge research, pressure from investors, extreme weather events, civil society unrest, and of course, we're all waiting to see what will be happening out of the US elections this year. Also, the opportunity of tilting portfolios towards green options has big opportunities for investors. The second session was very much around the launch of the transition paper, the think piece that CBI and Credit Suisse over the last 12 months have been working on, a path towards transition. And this is driven very much around investor demand being quite high for sustainable investments, and there's not enough supply. So we need to open up the market, create new opportunities, and diversify. But we most importantly need to tackle tough sectors. Tech disruptions are a part of the solution, but it's the existing industries that we really need to bring along the journey. So the transition paper is very much there to provide a framework, a proposed framework on that pathway forward. We also had government leadership for transition. And in that, the high-level messaging was investors' commitment to push for a greener global economy, and evolving government policies need to meet the ambitions that are needed, and connecting international investors to emerging market opportunities will be critical. Most of the opportunities that we will see and the need is going to be in the emerging markets. How do we connect developed economy capital into the emerging markets? This has been discussed quite a bit over the course of the last 3 days. We also had a market wrap up, which was looking at how transition really is about the entity. Clear strategic plans need to be credible and ambitious. Clear standards and industry engagement will be required. Going into day 2, First, we kicked off with the Moody AIB Climate Change Investment Framework. This was bringing together essentially the investment community, and the fund is going to be there to really push the needle on resilience investments, straightforward green climate aligned investments, and really looking to catalyze the global market. And so this was something that was launched yesterday and brought quite a bit of an excitement. And I think the main take-home message there is, particularly on the investor side, is, this is the direction of which the market is going to be taking, and these types of funds and the framework behind it will be an important component to make that happen. We then moved into regulator leadership in what we've particularly been seeing out of Southeast Asia, and gave a highlight to the ASEAN region, where we also made mention to the upcoming launch of the Sustainable Finance Institute Asia, which will be there to support regulators in achieving their ambitions. We also had a keynote from Lord Adair Turner from the Energy Transition Commission, where he laid out beautifully the action plan on what will be required, highlighting the role of green hydrogen in particular, along with CCS, renewables, and electrification. If you haven't had a chance to see that and you missed it, please do go back. It was quite an inspiring session in the conference. We then moved into transition imperatives, where we focused very much on the fossil fuel sectors, particularly oil and gas and coal. There we heard a lot from a world-renowned energy analyst, Mark Lewis at BNP Paribas, where he gave a stark view really on the end of days for these two sectors in particular, and the economic advantage that renewables will be offering. We also had some cases, Eskom out of South Africa and the transition plans that it's currently making, and also Repsol's most recently launched strategy for transition. In day 3, today, we started and opened with the opportunity for green hydrogen. There has been a lot of discussion on the opportunity green hydrogen has to play, particularly across all the major sectors. And so this really is about rapid cost reductions, is highly predictable, and will change the economics in clean energy in industries like steel and transport to near zero carbon in 10 years. Much of the prediction is decades beyond that, up to 40 years. But what we were hearing today for the first session was that this can be all done in 10 years. Of course, very clear policies are going to be required and an upscale in procurements, but we can get there. Big moves in transitioning the financial system was the session that followed. This was very much focused on starting with the central banks and what we've been seeing, how central banks have been mobilized, particularly under the umbrella of the NGSF, through Frank Elderson from the Dutch Central Bank, and also how the increase in understanding exposure to climate risks and the role that TCFD is now playing, and how countries and regulators are trying to integrate this. We also heard from CIO from State Street Global Advisors, Richard Lecow. The opportunity is in the emerging markets. Demand for local currency debt is there, and particularly an interest in the sovereign space. So this was an interesting discussion to be had, particularly on the central bank focus. And then finally, just before this session, we had transition to resilience. Now, we've been focusing a lot of transition being tied to the mitigation component of this climate agenda that we are on. But actually, this is very much about resilience as well, particularly in the light of COVID. And so we are not prepared for systematic shocks. That is evident. COVID has taught us this. We do need to have evidence-based standards to justify what needs to be done in resilience. This is going to be required. The crisis recovery must implement Paris Agreement. It must have resilient health systems, digitalization, for example. We really need to be rethinking the way in which we are building out. And then, of course, from Ratan Roy, always a sensational deliverer of his thought process, particularly on macroeconomic governance policy at this time, really needs to put safeguards in against inequality. We need to see, what are governments going to spend the money for? They need to provide reassurance to investors and to consumers that we will get out without you falling between the cracks. Restoration will be resilience for future shocks. So these were some of the headlines. And then to finally say, and I thought this was actually quite an interesting point made by Nick Robins, is that sustainable finance gives us a unique opportunity to make a difference in the time of crisis, which we have not actually had before. Coming out of the COVID, we need to be coming out of it in better shape, and sustainable finance actually gives us that chance. So I think with that, I will now turn it over to our panelists to react to some of the things that they themselves may have heard for some of the sessions they may have been able to participate in, and the rundown that I have just shared with you. A lot of content to run through. Sorry if that was moving fast, but I also want to make the most of time that we have in this last session for the day. So Danielle, I think if I can start with you to give us some opening remarks and some reactions to what you have heard just now.
Justine, thank you, and I'll keep it brief because I'm sure everybody is waiting for a good engaged discussions among us. And congratulations to, I think, 3 fantastic days. The lineup of speakers and the breadth of topics that you covered is exceptional. I just want to share a few reflections with you. I think that the last 6 months and the current crisis showed more than ever how important the sustainable finance market is, and how important the topics that we classify under ESG, sustainable finance, green, social, and sustainability, bonds and loans normally capture. And I think it really showed how the frameworks that we established over the last few years, the momentum that we have created, actually enabled a lot of the responses that we have been able to support companies with, societies with. Many of you know the green, social, and sustainability bond market, as an example, in the first half of the year was 155 billion, 21% increase versus the year before. And that is in a time where obviously a lot of market participants struggled. And I think what was particularly reassuring in this period is that investors more than ever stood by companies that were aligned to climate targets and to ESG targets. Many of you will have seen analysis that were done by BlackRock, by HSBC Research, that shows that ESG-aligned companies and climate-aligned companies significantly outperformed the market during the crisis. And I think that should give us all reassurance on both sides on how much we mobilized capital in the crisis and how investors responded, that the market actually is now mature enough to mobilize capital at a scale that we would not have expected a few years ago. I'm sure many of you went into this crisis with the same fear that I had. When you think about 10 years ago in the last financial crisis, people also talked about social responsibility, and then it took us 10 years to bring it back. And in this crisis, I feel it is more at the center than ever. I do have a however for you, as you probably would expect from my sort of enthusiasm that I started with. The however is that we still don't hit the real economy. So a lot of the momentum that we currently see is still very focused with governments and financial institutions. If you just look at the green bond market as a narrow representative of this discussion, it is dominated by governments and financial institutions issuing. Sometimes you see an energy company or transportation company, but be far away from getting into the sectors that you have talked about at this conference: the steels, the cement, the construction, the utilities at scale. And we all know if we want to achieve the transition, we need to get into these sectors. You all know 100 companies in the world are responsible for 70% of greenhouse gas emissions. Steel, cement, oil and gas, transportation, aviation, shipping. But do we see many of these companies accessing sustainable finance? We don't at the moment. And so therefore, I think it's really, really important that for the next few years, we are proud of what we have achieved so far in the green and sustainable finance market, but we also put a lot more focus on these transition sectors. I think we at HSBC, we're proud that we are number one in the green and sustainability bond market, but we also recognize there is so much more to do. And so we've published a white paper just a few weeks ago, very similar to, I think, the paper that the Climate Bond Initiative published. And so I think really good to now see that momentum And we set out a number of things that we believe need to be put in place to mobilize the transition. I'll be very, very brief, and then I'll hand back to Justine. I think the 5 things that we set out in our paper is: 1, we need agreed and transparent transition pathways. We will only mobilize capital if issuers and investors agree what does good look like. We then need disclosure standards that reflect these targets and these pathways. We know TCFD is seen as a success, and we should see it as a success, but it is highly inconsistent. And I looked at a statistic yesterday: only 4% of TCFD disclosing companies disclose along the full standards. So we know we have a long way to go on disclosure. The third element, I think, is we need to establish real transition finance instruments that we agree. That's transition bonds, sustainability linked bonds, but then also into the loan space. 4, I think the regulators are doing a fantastic job, but if you look at the conventional bond market, climate risk still isn't properly priced. And without proper pricing of climate risk, it is very hard to mobilize capital in the right way. And the final point that we've made in our paper is there are a number of government instruments. This is not an agenda that relies on government support, but obviously things like a carbon price, incentives on research and development, but also write-off of assets that are considered legacy would enable that agenda. So if it's of interest, you can find this on our Center of Sustainable Finance website as some more information. But in essence, I think we can be very proud of what we have achieved, but our big focus now has to be: how do we pivot into the hard to abate sectors and mobilize capital in the way that is needed? Justine, back to you.
Thank you so much, Daniel. That was fantastic. And thank you for sharing that. And congratulations to HSBC as well for their recognition of global leadership in the sustainable finance space. That is a huge achievement and an important role to play as well. And also your points made, particularly around transition pathways, which I think is crucial here. You know, what we've spent the last 10 years doing is proving that this market can exist. Particularly with the green bond. The green bond has been a symbolic product in the market that has gotten rallied the market participants around to get activity, get funds flowing into green investments. But of course, it was very focused on the projects and assets. It was, you know, clear-cut green, pure plays. And I guess the point is, after 10 years, we proved that this works. As you say, we now need to start moving into the harder to abate sectors, and that's the challenge before us. But of course, a huge investment opportunity. And so I'd like to turn to Sevinc, if you could give us your reaction to this market, the involvement of this market, and as an investor, what are you expecting to see? And maybe touching on particularly transition pathways at entity level would be great to hear from the investor's view.
Well, thank you for having me in this panel, and also many thanks for the great conference. First of all, when it comes to transition bonds, we are still in early days, but we have a perfect example, which is a green bond. Green bonds became quite mainstream. Hopefully it will happen also with transition bonds. Personally, I believe that ramping up transition bonds will have a greater impact on mitigating climate change than issuing green bonds alone, although they are complementary. And we need a combination of both of them. Well, with transition bonds, it takes sustainable finance one step further than green or sustainable bonds. What do we need as an investor, or what are the challenges? First of all, we need a common language or common ground, how to define a transition. And the white paper, which was published yesterday, I believe it will be an important step in the right direction. Secondly, we need a credible and ambitious business plan with explicitly stated milestones of the issuing company, how they will be aligned with the Paris Agreement. To conclude, the transition must be ambitious and genuine, no greenwash or transition wash. That's from my side.
Thank you, Sevinc. I'll turn it now over to Michael as a credit analyst and one that has also seen the growth of this market, particularly in the green bonds market, and how we're now starting to diverge into different thematic labeled products. What's your thought over some of the things that you've heard so far?
Thank you, Justine. It's a pleasure to be here. And again, I echo what my previous panelists have said as well. Fantastic past few days of conferences, some really, really valuable and unique insights. So thank you to you and the team at CBI.
Thank you.
It's a pleasure and an honor. Really what's caught my mind is a number of things. And principally it's been touched upon today in a number of panels, is on the massive opportunity and potential that's developing in the emerging market spaces. Really, a lot of the discussions that we're talking about over the past 3 days have been birthed, if you like, through Europe. A lot of the regulation has been developed within the borders of the European continent, but they're highly applicable outside of those borders. I believe Denise Adair earlier on from the IFC noted down it was a 29 trillion, I believe the number, it's a 29 trillion US dollar question in terms of the potential investments in terms of sustainable and climate change, for example. Some massive numbers. But the green bond market, particularly in LATAM, which is where BBVA has a significant footprint, is really what we've seen characterized by, yes, okay, an intense potential issuance base, lots of projects to finance, particularly on the resilience side of things, as the last panel touched on, a really strong investor base, particularly as Richard from State Street mentioned, that, you know, what emerging markets, green bonds can give you, of course, is two things: diversification of your portfolio and high yields. For an investor in Europe, when you're looking at green bonds of, you know, close to negative rates for the time being, having a yield pickup from EM issuers is beyond valuable. So really those two things, you're looking at potential issuance on one side, intense investor demand on the other side. We're missing the middle bit. We're missing the structure and the infrastructure to really get these bonds in play and become a major player in the market as they are in Europe. Work is being done in this space, but we need to realize the current state of play. The current state of play is that ESG disclosures and awareness on the whole amongst domestic corporates and investors still relatively low. There was a survey released by Banxico this year, in February of this year, that said only 13% of domestic asset managers had adopted the TCFD standards within their investing policies, 13%, whilst around 50% were completely unaware of what these standards were. So clearly there's work to do in terms of the awareness and education phase, that first phase of understanding from a corporate investor standpoint what ESG is and why it matters and what these standards are. However, the work being done by investors and regulators in Europe is clearly catalyzing a shift in interest and understanding in this space. That is clear, and it will naturally continue to increase the awareness as we go on. A couple of examples. The first is the International Platform on Sustainable Finance that was set up last year by the EU Commission to try and broaden the awareness of the Sustainable Finance Action Plan. For example, the bellwether taxonomy that we all know and love. Again, congratulations to Sean and the great work that he's contributed to that project. Green Bond Standard benchmarking regulation, which is key. And I think an underappreciated part of the Sustainable Finance Action Plan is that benchmarking regulation as well. But ultimately, we've seen a number of key emerging market players join this platform: China, India, Argentina, and Chile from the LATAM space, amongst others as well. This is key. Frank Elderson's NGFS doing some great work in terms of bringing the central banks outside of Europe into the discussions. The Central Bank of Mexico being one of the 8 founding members, and the Central Bank of Colombia has recently become a member as well. Obviously doing some great work in terms of preparing the resilience of the financial sectors towards climate change, adaptation and mitigation. So again, the discussions are taking place. There is positive evolutions in that space. What is being worked on in terms of the private level initiatives is pretty clear. It's disclosure, disclosure, disclosure. What we're seeing is investors engaging directly with corporates to try and engage with them to disclose information alongside those existing standards, the TCFDs, GRIs, for example. It's starting on a micro level with individual investors going to these corporates and saying, hey, we know you have this information. Here are some nice international standards that are fairly plain and simple to adhere towards. let's try and move along those pathways to get it done. And clearly, a natural pathway is that green and sustainable bonds will naturally increase in interest over time as these disclosures start to become wider spread throughout those geographies. And again, the prospects for transition bonds remains relatively high in this geography as well. Looking at financing that transition away from those harder to abate sectors, whilst also ensuring that just transition. And I think your colleague Rafin highlighted this really, really well in that previous panel of ensuring that the green bonds don't just adhere to a positive environmental evolution, but they also ensure that there are positive social outcomes as well. I realise this is part of the wider taxonomy, i.e. making sure there is at least not a negative social impact, but this is clearly of a heightened risk in those emerging market economies.
Thank you, Michael. That was a great rundown. And I think some of the things that I'm hearing from you is that at least it's very encouraging from my perspective, particularly the work that I focus with our regional teams, is how to connect what is happening internationally. For example, the EU taxonomy, the IPSF, and how that's trying to also work towards harmonization globally. And I think what we're seeing for the first time is this exchange of knowledge and flow of knowledge that we haven't actually been able to achieve in past cases of similar types of initiatives. And I don't mean just particularly with sustainable finance. I mean, things coming out of the EU don't always necessarily translate. You say you focus a bit on the Latin America region, and so what are you seeing there that is, I imagine there's a lot of questions around transition. Where do you see some of the key sectors out of LATAM being the most beneficial to getting onto this market?
It's a good question. Into the green bond market specifically, it's really where we see the traditional sectors in Europe. As Daniel mentioned, really utilities and really sovereigns as well. I think Nick delivered a really strong message on this, the potential for sovereign issuance. And again, sovereign issuance in a resilience platform. The Dutch sovereign bond was pretty, strong on saying they're building flood defences, and that's part of their green bond framework. We expect this to come from sovereign issuers in the LATAM space, and really those typical places that you see in terms of the utility sector. And those harder to abate sectors, maybe they'll take some more time, because again, the process at the moment is more about education, understanding what our operations are, trying to align with those international standards. The natural first step. Then we can look at, okay, how do we finance that transition? These are the instruments that's available to you. It's a bit of a walk before we can run kind of scenario.
Yep, that is exactly right. Well, let me turn it now to Anna. Moody's obviously has been very much involved with the market development of green bonds and other thematic bonds, and of course known very well for its green rating that it put into the market a few years back. How is Moody's looking at transition in this transition market, and will you be looking to do the same thing as you've done for green?
Thank you, Justine. And thank you, by the way, for a really punchy and insightful summary that we started this conversation with. And thank you, my fellow panelists, for insights, Daniel, Sevinc, and Michael. Justine, I'm just gonna, echo some of the messages that we've discussed here that really resonate with me and align with how we see transition. First of all, just, want to echo back the importance of the economy-wide transition to low carbon economy, and sort of echo what Daniel was saying about the importance of bringing the high emitting sectors into the conversation, into the sustainability conversation. As you said earlier, green bonds really laid the pathway to show us how it can work. And it's now very important to bring those sectors that are responsible for most of the carbon emissions, the high emitting sectors. And to that end, the transition label, the transition infrastructure, and the transition standards around what constitutes credible transition are very important and very helpful. You talked a little bit earlier, Justine, about the importance of investor focus and pressure from investors. And, I want to echo that back. Absolutely. We are seeing rapidly growing focus from investors on ESG factors and sustainability factors that go beyond financial materiality and beyond returns, right? Focus on sustainability credentials of the issuer. And I think that is very important force behind moving the economy towards low carbon future. We talked, I think all the panelists mentioned the importance of standards. Obviously, to the extent that high emitting sectors join the conversation and we talk about transition, what constitutes credible transition, we absolutely need standards and lines around what that is, what we think is good, what we think is the right pathway towards meeting Paris goals and what that means for different industries, since this is obviously going to be very industry specific. So it's standards around what constitutes transition label and what that entails. You know, in case of sustainability linked instruments, standards around what are the right kind of KPIs, what are the credible KPIs. It's also the standards that Michael spoke a bit about, just general ESG disclosure standards. You know, right now we have different frameworks, some voluntary, some not voluntary, around ESG disclosures. And I think to the market, it's going to be very important to have continued harmonization of those ESG disclosure standards around the world. It's also, you know, we would agree with the importance of entity level strategies, right? So it's not just transition at a project level and defining, you know, what's the right kind of green project and what's the right kind of transition project, but it's very important to look at the alignment of projects with the entity level ambitions and strategies and goals. And Sevinc, you touched on it, I believe. Very important to see how the entity as a whole is transitioning towards alignment with low carbon future. Yeah, and I think, and the last note I would say, you know, when we're talking about transition, the way we would think of it is that, you know, obviously we're talking about emissions and transitioning towards low carbon future, but social factors are very important. One of the panelists touched upon, I think maybe it was you, Michael, but just the importance of looking at transition kind of holistically, not just about low carbon future, but also how do we make it socially just and socially sustainable as well. And that's certainly how we look at it.
Thank you, Anna. I do want to turn to one point. Sevinc, you had mentioned around the need for business strategies to set very clear milestones. And then actually, we'll turn to Daniel now, particularly the points that you'd raised, highlighted in your paper. One was very much around financial products to help finance the transition and having a diversity of those to choose from. And I think, are we talking about another label, transition bonds, or are we potentially looking at what we already have, looking specifically at the sustainability-linked bonds and loans that has been emerging, which does look to set that milestone type concept to be able to track performance based off of commitments at entity level. What are your thoughts about that particular point?
Yeah, I think we're currently in a phase where I feel we are experimenting almost what is the right next phase of this, right? I mean, a few weeks ago, we placed the world's first plastic removal bond for Henkel, and suddenly you go very specific. And I don't think that is a problem at the moment. I think the market needs to work out between issuers and investors. Are we willing to expand the green bond framework that we essentially have into high carbon sectors? Or are investors actually more comfortable to keep the green bond framework and the green bond, therefore, actually quite clean, quite green in its pure definition, and actually find a new framework for high carbon sectors? I think if it's the latter, which I feel at the moment is the preference of many investors, then I think we need to have both a framework that is proceeds based and one that is KPI based. So the sustainability linked bond framework and loan framework is great, but many investors, I think, have an interest not to just support an overall company, but actually make sure that their money is invested into specific projects. And suddenly I think the transition bond has a right to be there, but I also recognize that we can't confuse the market too much with too many different definitions. So while I think it feels a little bit Wild West at the moment, the next 12 months, I think, will sort out that in the end, I believe you will land in 3 different frameworks: a very pure green bond standard, something that focuses on transition, and then the sustainability-linked framework that is focused on overall company transformation based on overall company KPIs. If we land in a place like this, I think we have a framework that will actually encourage investors to mobilize more money.
How much do we think the role of the EU, there was a lot of discussion in the first day around the role the EU taxonomy can play in this. Mostly the next phase of it is getting down to dissecting into sectoral strategies. I think this is the one thing that everybody's looking for is, well, if this is the steel, cement, oil and gas sectors, what is our direction of travel? Any thoughts on that?
So I think the EU work is fantastic because somebody has to do it, and they've done the work, and obviously Sean heavily involved in this. At the same time, I think we also know that a capital market only works if a definition is adopted quite widely. And therefore, I think that the EU taxonomy will inform a lot of this discussion, but I could also see that we end up in a framework that is similar to what was designed with the ICMA when we defined the green bond, and actually find something that is based on the taxonomy, but maybe in a first stage, a little bit lighter touch. And I would expect that these two dimensions will grow together over time. I don't know of the people that are on the call, how many people have read the 400 pages of the taxonomy. I think it will take a little bit of time for those two frameworks to properly come together. But I applaud the EU because somebody had to do that hard piece of work, and they've done it. So kudos.
Yeah, I mean, there's definitely going to be an implementation phase, and this is from CBI's own experience. Putting it down on paper and putting the intellect on the paper is one thing, and making sure that it's taken into the hands and put forward is the next phase of this, right? But I think that we can be looking at it potentially as that guidance, and I think that's some of the good points that you make. Sevinc, how is the PGGM looking to the developments that are happening on taxonomy work? And two, I guess also this, I'll go back to you as well, Michael, and Anna, for some reactions on the role of regulation, because to your point, Daniel, you know, at the moment it's still unclear as to the extent at which the EU will be taking the taxonomy forward. It's looking quite promising that even in that sense, it's going to be prioritized and put into a regulatory component. So role of regulation as well for scaling up. And we've been hearing from the conference about the role of regulators taking a lot more seriously the development of sustainable finance. So threw a lot at you, Sevinc. So your thoughts in regards to some of the points that I've just put on the table.
Towards taxonomy, we welcome this development, and we are also an active member of the working group of the EU taxonomy group, because this taxonomy will create a level of playing field for different sectors. Because as an investor, we also not know which sector is clean or not, and then this regulation will make our life easier. Normally, regulation will make us life difficult, but with this point, it will make us our life easier, because we have also other obligations like reporting towards our stakeholders about which kind of CO2 reduction which we have realized in our portfolios, and this taxonomy will help us in a good direction. So I'm very grateful for the people who are working in this working group. So that's my answer in short, in a nutshell.
Thank you, Sevinc. Michael, any reaction? Sure.
No, I think it's important to highlight not just the role and the kind of enthusiasm that we all have for the taxonomy, which, by the way, is fantastic. You know, the fact that we're also enthusiastic, but you know, as Daniel said, a 400 page piece of legislation. I mean, I haven't heard that much enthusiasm about something so large for a while. But what I think is important, and what will start to allow the implementation phase to speed up and be catalyzed, is Anna's cousins at Vigeo and their various competitors. The role that these ESG ratings analysts play, or analysis providers play, not necessarily for larger asset managers in Europe that have the resources capable to sit down and have people comb through the taxonomy and implement that through their portfolios, but through maybe to the mid and smaller investment managers throughout Europe or through the emerging markets. That intermediary role that those ratings providers play, and they could potentially play in integrating these standards and rating these portfolios almost automatically once a framework is developed and somewhat implemented through these ratings providers. That is crucial because, again, trying to understand all of these various technical criteria, how they're implemented in my portfolio. You know, it's a multi-asset fund. I haven't just got green bonds. I've got maybe equity holdings, commodities in there as well. It's not an easy ask for a number of smaller investors that shouldn't be ignored in this space. So really, that's what I see as a key contributor to kind of grease the wheels of the implementation phase going forwards. A bit of kind of shameless marketing for your cousins there, Anna, of Vijaya. Other ratings providers do exist.
Appreciate it.
So yeah, I think that is a good point. But what we have seen is something very interesting development where other countries paying attention to what's happening in the EU. So it does go to show that when government institutions, public sector institutions do take initiative, the economy reacts. And most notably, Michael, in LATAM, we've seen Colombia, Chile now about to embark on their own taxonomy work. So I think the main thing here is that we've got something to work with, especially in this transition space. You know, we talk about the need for standards, we need to talk about frameworks and so on, but we're not really starting from scratch here. You know, we're starting to get some level of a sense of direction. The question is, you know, fleshing this out further and having some test cases in the market. So have we seen anything? We're just recently, Repsol has, you know, launched their sustainability transition strategy. We discussed that yesterday in the transition imperative session. And of course also ESCOM as well out of South Africa. Do we have any examples that we're seeing in the market that any of you feel is worth mentioning that is really taking strides in this direction? And if any reactions to those other two corporates that I just mentioned. Maybe Daniel, I'll start with you.
Yeah, so I wouldn't even go into specific names. I would take this much more broadly. I think if you look at where markets are at the moment, equity and debt markets, it is finally, I think, at the place where it is a commercial reality that you want to invest in companies that are transitioning. If you are a lender or a debt investor, you now realize that transition risk that we thought we had 10, 15 years to work through just happened now. COVID brought, I think, a decade-long transition to the here and now. Look at the oil price, look at the transportation sector, the airline industry. I can go through many sectors. The fourth industrial revolution essentially happened within a quarter. So from a debt investor, you're worried about transition risk much more than you ever have. And if you're an equity investor, you suddenly realize where the multiples are going, right? I mean, I don't need to point out Tesla because it's discussed everywhere, but just the fact that Tesla is now worth more than almost the entire conventional auto industry together is something that, even if we don't believe that valuation is right, investors will suddenly move. And you see the same in the oil and gas industry. People are rewarded for painting a positive vision of the future. Even if that vision may in the interim hurt dividends, hurt payouts, there is now a recognition, I want to invest in a company that actually will be around in 10 years from now. And I think that's really the encouraging bit that I think we all believed in will happen, but it seems to be there, and I can only hope that it stays there. But I think all the indicators are there. And again, I think the automotive industry and the oil and gas industry are just two examples of a much wider movement.
No, this is very true. I mean, this was a conversation coming out of the transition imperative session. Mark Lewis laid it out beautifully. The economics are going to play out here as well. And it's clear that, the upfront costs of the oil and gas is exceptional and only going up, and renewables is, at the infrastructure level and This is, you know, prime for debt financing. We've seen this in the green bond market. The largest portion of shares of proceeds is going to the renewable energy sector. Investors love this. So, you know, this is exactly what we would expect to see. Anna, do you have any thoughts on this in terms of Moody's perspective on what we'll see in the decade ahead?
You know, I think I just want to highlight sort of importance of standards. I think you spoke a little bit about regulation earlier. I mean, for sustainable finance market to continue to grow, and especially for it to include the heavy emitting sectors, right? The investor trust is absolutely critical. And you know, my earlier background before Moody's was in accounting. I was an auditor, so investor trust is near and dear to my heart. And for investor trust to be there needs to be consistency, and there needs to be clarity. That everything we are talking about today, there need to be standards. We're talking about the EU taxonomy. I mean, that is, as Daniel was saying, that is a huge amount of work, and it's somebody had to do it, and it's excellent that it's there. It's a great start. We do think that it's a little bit more helpful, you know, at a project level, right? Determining what kind of assets, what kind of activities are sustainable today. And maybe we need a little bit more in terms of being able to figure out what constitutes a credible transition at a whole entity level, the entity strategy level. And that may be industry specific, and would probably need to evolve more market standards around that. And I think CBI's paper that you just did with Credit Suisse, I think that's excellent discussion of that too. So anyway, I just want to reflect back that I think this development of market standards and definitional clarity and standards around what we think is credible transition, both at project level and entity level, I think is critical.
Thanks, Anna. Well, I think, look, we have a lot of lessons to learn in the development of the green bonds market to carry over into transitions. We do have a huge opportunity before us. And so I think that this is something that we need to keep in mind. We are starting to come up across the hour. And so I just wanted to give our panelists just one last comment before I go into closing remarks. Sevinc, let me turn to you.
Well, my closing remark is that whole transition bond new development is a good development in the right direction, because there's a big chunk of the economy which needs to be transited towards a cleaner one. So, and then we need a credible story from those companies in order to invest in them. So trust is the most key element in this whole issue.
Thank you, Sevinc. Michael.
I think final comments, really, I think this whole idea of a transition instrument is phenomenally exciting, and there's an awful lot of potential there. But primarily, I think it shows us that we're on the right path in terms of ESG analysis. I think this dilution between, as Anna was mentioning, a more project focus, which, okay, we can understand that's where the regulation's heading on the taxonomy and the green bond standards, but no longer is that disconnect between what you're financing and what the rest of the operation is conducting as a business. No longer is that disconnect as strong as it was. Really, the idea of these transition bonds is diluting that disconnect, saying, okay, you're trying to finance your way out of your hard-to-abate sector, but give us some really meaningful targets. And I think really reading through the CBI's principles for this transition, it's that final one, the fifth one, that really stands out to me. You know, making sure that you're actively following that path. Show me, report to me over time that you're meeting those interim targets, so that I'm not surprised in 30 years that you've completely missed it, and we've completely missed that 1.5 degrees Celsius.
We kind of want to avoid that. We only have one chance here.
Exactly.
We need to get it right.
That's the idea. Daniel,
finish us off.
Yeah, I mean, I can only echo what Michael just said, and I think the only thing I would add, we gained a little bit of time with the delay of COP. I was quite nervous when the original COP timeline and book of work was announced, especially the private finance book of work, which was and is very, very ambitious. We gained a little bit of time to do it, but we shouldn't waste this time. So I think we have about a year now to agree on a number of things that we've been discussing for quite some time, right? We're talking about the lack of disclosure and data for so long. We're talking about mobilizing transition sectors for so long. We're talking about climate risk pricing and the impact of regulation for quite some time. I think we have now 12 months to work this through, mobilize the market, and hopefully when we're back together at the next CBI conference and then at COP26, we can show a few success cases of this. So I think that's all I wanted to add, and a big thank you to you and the organizers.
Thank you, Daniel. Thank you. It's been a great session, and I really appreciate our speakers today giving their insights. And so I just want to spend the last few minutes with closing remarks. I have been making so many notes over these last 3 days. The content has been so rich, and honestly, it's gone beyond our expectations of what we could have achieved in the discussions. We know that there's a lot to do, and also doing this under a new format that CBI is testing for the first time. So I also want to say thank you, and to your patience for those listening in where you've been holding out as we work through that. We have an amazing tech team behind us, and I want to say congratulations to them and to Alicia and others in the team for all their hard work in getting this. You can't do this alone. You have to have a strong team behind you, and that's what we definitely have at CBI. So look, the transition, it's inevitable. In fact, the transition is already underway. This is what we've been hearing over these last 3 days. The question is, how fast will it move to ensure a successful outcome, one that is going to address our current climate challenge? Industries and high emission sectors that do not transition or do not transition fast enough will be at risk. Their access to existing channels of finance will be limited. Investors are making this clear. This will be a moment of survival of the fittest. You must get ahead of the game, or you will be at the back of the line. The economic disadvantage is what you're going to be up against. We have heard in these last days the advancements the global financial system is taking to move towards a greener, sustainable economy. Everyone has a role to play. It will not be down to one segment of the market. For government, we're going to be looking for strong, effective policies. From industries, we're going to be looking for credible, achievable transition plans. For regulators, the market infrastructure that you can put in place to help foster the shift is going to be critical. And investors, I cannot say enough, demand, demand, demand. It is growing. We need to see more of it. There is a platform, a plethora of credible initiatives globally that is emerging. We are seeing asset owners becoming more active engagement with their asset managers. We are seeing the rise of regulators, the central banks in particular. Just this week, CBI signed an MOU with Central Bank Governor of Brazil, where we will be supporting the bank in integrating TCFD and other tools to transition towards sustainable finance within the Brazil economy. This is huge. As little as 2-3 years ago, we wouldn't have even been able to get a meeting. To give you perspective, the EU Commission, as we've discussed today, the steps taken towards putting in the taxonomy work and other sustainable finance policies, all of this has set an example to the world, and you're seeing other nations react to that. I come back to the transitions that we're seeing from various companies that are coming into market. And of course, we cannot ignore what the last 10 years has shown through the global thematic label debt market. As our dear friend Julie Becker from the Luxembourg Stock Exchange put it so well yesterday, we need to go big and we need to act fast. We have an extraordinary investment opportunity before us. Let's grab the bull by the horns that will bring the change needed to secure a sustainable future for our world. At CDI, we have been privileged to be at the epicenter of the development of the green bonds market. In our last 10 years of operation, we have been there to support market stakeholders through our market development programs regionally around the world, our capacity building, our market outreach and education, our standards development, our market intelligence, and market data services. CBI has worked hard to empower the market with the tools and knowledge required to truly achieve a low carbon and climate resilient economy at scale and speed. Thank you to our excellent speakers, our CBI partners, and sponsors, most importantly, including our listeners. We hope you have enjoyed the last 3 days as much as we have. We have our homework cut out for us. Let's make sure we make it happen. Thank you, everyone. See you next year.